Welcome to the fascinating world of alternative investments. Unlike traditional assets like stocks and bonds, alternative investments can provide unique opportunities for growth and diversification. Understanding these options, like private equity, venture capital, and crowdfunding, is essential to know how they work and what risks they carry. With many new businesses and investment funds emerging every day, these terms are becoming increasingly relevant for investors. Whether you are curious about financing a startup, exploring new investment funds, or just want to understand your options, mastering these basics can be a game changer for your financial journey. So, let's dive in and explore what each of these terms means and how they fit into the investment landscape. Private equity refers to ownership or interest in companies that are not publicly listed on stock exchanges. These companies are often bought or invested in by private equity firms or wealthy individuals. The goal of this investment is to improve the business and later selling it for a profit. Private equity investments typically involve holding onto the company for a period of years. During this time, the investors work to increase its value. While private equity offers potential for high returns, it also comes with risks. Private equity investments are often illiquid and cannot be easily sold. For beginners, private equity might be something to explore as a long-term investment strategy, especially if they have access to higher capital and want to invest in promising companies that are not yet available to the public. Venture capital is a type of financing provided to startups and small businesses with high growth potential. These investments are usually made by venture capital firms or individual investors who provide the capital in exchange for equity or ownership in the company. Venture capital is often essential for startups because it helps them scale up quickly. This helps the company to fund research or develop new products. While venture capital investments can lead to substantial profits if the startup succeeds, they are also highly risky, as many startups fail. For beginners, venture capital can be an exciting area to explore, but it is essential to understand that these investments are typically reserved for experienced investors or those with a high risk tolerance. Hedge funds are investment funds that pool capital from accredited investors. Hedge funds use various strategies to maximize returns, such as short selling, leveraging, and arbitrage. Hedge funds are known for their flexibility, allowing managers to take aggressive positions. They aim for high returns regardless of market conditions. However, hedge funds are also risky, and their complex strategies require a deep understanding of the market. Access to hedge funds is generally limited to high net worth individuals or institutional investors due to the high minimum investment requirements. For beginners, hedge funds may seem intriguing, but they are best understood as high risk with high reward investments. It requires careful consideration and a solid foundation in financial knowledge. Crowdfunding is the practice of raising small amounts of money from a large number of people. It is usually done through online platforms. It is commonly used to fund creative projects, new products, and even business startups. For investors, crowdfunding offers a unique opportunity to support businesses they believe in, and often with relatively small contributions. Crowdfunding investments can be rewarding, especially if the venture succeeds. But they also carry risks, as many startups and projects may not meet their financial goals. For beginners, crowdfunding can be an accessible way to invest in early-stage businesses or support new ideas. But it is important to research each project and understand that not all ventures succeed. An angel investor is an individual who provides capital for a startup, often in exchange for ownership equity or convertible debt. Unlike the venture capitalists, who typically invest through funds, angel investors use their own money to back entrepreneurs. They invest often during the early stages of a business. Angel investors play a crucial role in the startup ecosystem. They offer financial support, and in some cases, mentorship to budding entrepreneurs. For beginners interested in startup investing, and becoming an angel investor can be a way to support innovative ideas and gain exposure to potential high-growth opportunities. However, like all early-stage investments, it carries high risk and requires thorough research and a willingness to accept potential losses.